Allow me to tell you some problems, and I will promise you that they all have to do with how the current monetary system is set up. For example, increasing high housing prices, increasing debt levels and foreclosures of small and medium businesses, highest inequalities in world history at the moment, growth dependency and the constant need to destroy the ecosystem and to keep extracting more and more resources from the planet, low salaries of working class around the world. How can all these problems have to do with the monetary system? Well, it's easy, but in order to understand it, we need to uncover some key assumptions that economic discipline has made wrong. And the first one is that money is neutral. It's incredible how many people that run the system, that are working in the highest levels of regulatory or in the private sector of lending and so on, in the financial sector, do not understand how money works. They, as most of us, think that banks are mere intermediaries, that they lend the savings of other people. And thus, these assumptions get reflected in the economic models, mathematical models, that they use to predict the future or to explain the relationships between economic variables. But these assumptions are wrong. I know I did think about this in the past. I thought that banks lent the savings of other people, but it's not the truth. And it's starting to be acknowledged and accepted by many economists that banks create the money that we use, at least most of it. It's true that the cash, the coins and bills are created by the state, that there is another digital form of money that are called bank reserves that is also created by the central bank, but only banks can use it. So the most part of the money that we use, more than 90% of the money we use, is bank deposits, is bank money. And this kind of money, it's the digital money that we have in the bank, is created whenever a bank gives out a loan. So the more loans a bank give, the more money is in circulation. And the more loans are repaid, the less money is in circulation. And this is the most part of the money that we have. So money is not a neutral thing. And we should have taken into account that the more banks lend, the more into debt that the small and the private sector is with the banking sector, the more money is in circulation. And this is important, believe me, because banks, especially now, are small, are bigger, and there are so few of them. They tend to be less and less and bigger and bigger. And what do big banks lend to? Well, they lend to big businesses. They lend to big corporations. They lend most part, 60%, 70%, it depends on the country, but they lend to speculate on the markets, to buy assets that are already there, out there in the economy. They are not investing in increasing real production of goods and services. They are investing on speculation of the value of the assets like cryptocurrencies, but especially housing and financial assets. That is buying the rights to loans and to other kind of gambling instruments that are around there. So this is important because if banks lend most of the money to the real economy, we would see like lower interest rates for the loans for the enterprises, and we would see less rents, less money, less income earned in the financial markets that are actually more bigger than many of the real economies in the world. So this is something important. Also, we have the problem that whenever the banks create money for a given speculation purpose, they are increasing in this way the amount of money that is going to this particular asset. And this creates an inflation of the value of that asset. That means, for example, if they lend too much money to buy houses that are already built, the price of these houses will start increasing because they are creating more money into this sector. This increase in the value of things can go on for so long and create a bubble. For example, a housing bubble like one like that we had in 2008 in many countries. these bubbles end up bursting, and when banks feel like they have made too many bad loans, their profits go negative, and they can go into bankrupt. But this is something the state cannot allow to happen, because, believe me, the money that we use, the money that you have into your bank account, is not really yours. It's not money that is somewhere around waiting for you to take it out. It is just a promise of the bank that whenever you want, you could take it out in form of cash or a bank transfer, but it is a promise. So what happens with a bank that is going bankrupt? Well, it fails to deliver on those promises. All the money that we thought we had in the bank disappears and stops being money at all, because banks use fractional reserve. They only have a small percentage of assets that back huge amount of deposits, of promises of the bank with the people or enterprises that have their money into it. So what would it mean if a bank crashes and the state does not do anything? It would mean that this money would disappear. People would lose the savings that they had in the bank, and this would create a cascade of bankruptcies, because everybody would want to take out their money, and because of the fractional reserve system, no bank would be able to fulfill their promises, and they would all collapse. So the system is very fragile at its core, and it is like pushing the states to go into the rescue whenever banks do a bad job doing their business. That means giving out bad loans that cannot be repaid because they are bubbles or other reasons. So this is the functioning right now of the system, and the banks know that the state is going to rescue them, and so they go into the riskier investments that they can, because they know that in the end they are going to be rescued by the state, and this way they make a lot of profits. So we know, the economic profession assumes that money is neutral, and that is a very wrong assumption, and this is starting to change right now. But many of them think that there is no problem on banks creating money, because, if they do bad loans, they would be the ones that go bankrupt. So the market will be in charge of them competing with each other, trying to do their best with this ability. What we have seen is that this is another wrong assumption. The banking sector is, like many others, a market where real competition is not happening. And there is a strong tendency for oligopolies and monopolies. Like efficient is not the king of the party, power dynamics are. And all these relationships between the banks and the political powers as well. So at the end, what we have is a system that goes into crisis from time to time, and whenever it does, the state has to rescue it. The state is backing all these private profit-making activities, and this system is totally wrong. It's costly, it's very expensive for the public purse, and its benefits are not that great. It only makes lending easier, but banks decide where to lend. For example, if you want to invest in a business, you have to save first or to ask for a loan in order to invest. But if a bank wants to buy an asset or invest in something, they can create the money. So this is a huge inequality. And like this, there are many others. For example, banks are the only ones that can use the bank reserves, this digital form of public money that cannot be fragile, that is 100% secure. So things are starting to change in this sense, because we are accepting that maybe the state has to have a crucial role providing these services, because the state also creates value. And this is another assumption that is very wrong. Many economists may argue that the state should not intervene in money creation and that markets should be the ones in charge. But we have seen the problems of this until now. But, for example, roads and other public infrastructures do also create value. There is value on the state providing to the market some key infrastructures. And I believe, and many of us believe, that money should be one of these infrastructures. Money could be a public good provided by the state or by a state institution like a central bank or a monetary register, and which would be free of risk. and other market participants couldn't and shouldn't create the state money. And this would be a remedy, a solution for all of these problems, but we should have to acknowledge that money is not neutral, that markets do not behave in a rational and efficient way, and that the state can provide value to the whole system by providing public infrastructures. Once we understand this, then it's easy to see how, for example, not having this ability of banks to create bubbles would help us to reduce inequalities a lot, would help us to reduce the level of debt that is in society. People will have more money in their pockets, more savings, and more power over what are these savings used for. Also, the system would work as we think it would work. Banks would become intermediaries again between lenders and savers. And these less amounts of debt in the economy would mean that there are less interest paid from the ones in debt to the ones that lend the money. Also, by having a safe money, we wouldn't need all the banking protection that we have today. There would be no more banking rescues, and there will not be the need for immense regulation and immense privileges that the bank have nowadays. And this would allow for much more competition in financial services, in financial intermediation and payment services, probably increasing and improving a lot the quality of the services and the price of these services. Because do not forget that right now, as the banking oligopoly takes over the world, for example, when the interest rates go higher for the banks profit from this, from the central bank reserves, but they do not compete between them to increase the rates that they give to deposits. So they have made huge amounts of benefits because now they were able to maintain, to cooperate in order not to put these interest rates on deposits too high. So they are cooperating, they are not competing, and thus our financial services are very expensive for the people. If we changed the system and the money was again a public good, we had digital public money, then we will see a more liberalized financial sector that probably would reduce the cost for us in a huge amount. So this is something. Also, if we have less debts in the world, we have less need to growth. We are less dependent on growth. And having a public institution creating the money would mean a lot of benefits for the society. For example, whenever more money is created, it is just a benefit for everyone and not only for a private sector like the banking sector is today. So there are many different ways in which this reduce inequality and all these less costs for the state would benefit the vast majority of us and would reduce the power and the size of the financial markets.